They told you the metal was calm. They told you the market was normal. Then silver ripped into the 80s, snapped back like a bear trap, and left everyone asking the same question. Was that a rally or a warning shot? Because what actually happened is simple. The paper price swung violently while the real world, physical supply, sovereign demand, and the plumbing under the financial system got tighter. And when the plumbing tightens, price doesn't drift. Price jerks. We're going to talk like adults today. No cheerleading, no doom poetry, just the mechanics of why precious metals are moving like a live wire, why the bond market's silence is suspicious, and why one medium-sized buy order could wipe the retail shelves clean. And yes, this is educational. We manage risk. We don't gamble. Now, first, the volatility you're seeing isn't random. It's a symptom. Silver doesn't just go up. It stamps. Then it gets yanked. That's what happens when liquidity is thin and leverage is thick. Think of the paper market like a casino with a tiny cash drawer. The chips can fly around all night until enough people ask for cash at the same time. Then the dealer's smile turns into a stare. Here's the mistake most people make. They watch the chart and assume the chart is the reality. But the chart is the shadow on the wall. The real object is the flow of metal, the flow of credit, and the flow of trust. So if you're wondering why silver can print 84 overnight and then wake up back near 70, don't start with mystery. Start with structure. Now watch this. The bond market, the place that normally screams first, has been weirdly quiet. Most global bonds have been sleepy, until you look at Japan. That's where the floorboards are creaking. Japan spent years defending rates like it was a religious mission. Lines in the sand. This yield shall not pass. But markets don't care about vows. When pressure builds, even a central bank's wall becomes wet cardboard. Why does that matter to us? Because the Japanese carry trade has been one of the hidden engines of the entire risk-on era. Borrow cheap in yen, move the money elsewhere. Buy anything that moves. Stocks, crypto, tech, whatever has a pulse. That trade isn't a headline, it's a pipeline. And when the pipeline cracks, it doesn't leak politely, it whips. If yields rise and the currency moves, the cost to unwind that carry trade spikes from two sides at once. Interest costs climb. Currency costs climb. The free money suddenly has a bill attached to it. And when big money gets a bill, big money sells what it can, not what it wants. So here's a question we should all be asking. If the carry trade starts reversing hard, what gets sold first? Assets people love or assets they can sell quickly? Exactly. And that's why we can get these violent slams and spikes in metals too. Not because the story changed overnight, but because the funding conditions changed. Liquidity is the oxygen. When oxygen drops, everything gasps. Now, don't get distracted. The deeper story is physical. Paper metals are a promise. Physical metals are a thing. And the entire game of the last decade has been selling promises faster than people ask for the thing. But here's what's different now. Demand for the thing is no longer just coin collectors. It's not just stackers. It's institutions. It's countries. It's manufacturers. It's supply chains that can't pause production because a spreadsheet says, sorry. We're watching nations behave like it's late in the game of musical chairs. When the music is playing, everyone smiles. They trade paper. They accept IOUs. They store their metal in someone else's vault. They leave it overseas. They assume the system will always be open. When the music slows, people start touching the chair with their hand. When the music stops, they don't ask politely. They grab. That's why repatriation matters. That's why sovereign buying matters. It's not about a price target. It's about trust. Countries have watched assets get frozen. They've watched payment rails become political weapons. They've watched your money turn into our permission. So they're doing the logical thing. They're stacking universal collateral. Gold is the headline because central banks can absorb it easily. But silver is the quiet pressure point because it's both monetary and industrial, and the market is smaller than people realize. Now here's the contradiction that should keep you glued to the screen. Retail availability can look fine right until it doesn't. We've seen this movie before. Everything looks normal on Friday, then Monday arrives and the shelves are empty. Dealers stop quoting, delivery windows stretch, premiums jump, and you realize the spot price was just a number on a screen, not a guarantee of supply. Why does it flip that fast? Because most dealers don't run on infinite inventory. They run on shipments, allotments, refinery output, mint schedules. One broken link and the chain snaps. And when people sense scarcity, they don't buy one. They buy 10. Human beings are not robots. Tell a person they can't have something and suddenly it becomes the only thing they can think about. It's the same instinct that kept our ancestors alive. If the tribe is rushing toward the river, you don't ask for a committee meeting. You run. So when premiums jump in a week, that's not just pricing, that's nervousness. It's dealers protecting themselves against the cost of replenishment because they don't know what replenishment will cost or if it will even arrive. And once dealers pull back, the public misreads it as greed. It's not greed, it's survival math. Now, let's drop a grenade into the room. The retail market can be cleaned out by an amount of money that sounds big to normal people, but is pocket change to institutions. Imagine a single buyer showing up and saying, "We want every US silver coin we can find. We want every bag of old circulation silver. We want historic gold coins too." Not because they're collectors, because they're converting paper wealth into portable collateral. A trade like that doesn't need billions, it needs tens of millions. In today's world, tens of millions is a rounding error for a fund. It's an office renovation for a tech company. It's one executive bonus pool. And yet it could erase the visible inventory that makes the public feel safe. That's the razor-thin equation we're dealing with. So if you're still thinking, "I'll wait until the stock market tops, then I'll rotate," hear this clearly. The rotation window might not be priced in dollars. It might be priced in availability. Because when the crowd turns, the door isn't wide. It's narrow. And the first people through the door don't hold it open. They slam it behind them. Now, before we go further, we have to talk about the new poison in the information stream, AI-generated commentary. This isn't a side topic. It's part of the volatility story because it creates panic loops. We're seeing experts that aren't experts, faces that aren't faces, voices that never existed. And the dangerous part isn't that it's fake. The dangerous part is that it's half true. Half true is the perfect weapon. Because it borrows credibility from real analysis, then injects a few wrong numbers, wrong dates, or a dramatic timeline, and suddenly viewers think the apocalypse has a schedule. That's how you get people calling in terrified, asking if they should dump everything because an animated avatar shouted, "Sell." So we need a rule as a community. Separate the logic from the details. Logic. Tight supply plus rising demand plus stressed credit equals volatility. That is coherent. Details. There are exactly X ounces left, or on this specific date the system fails, can be nonsense. If we treat every viral clip as a final truth, we become prey. And here's the deeper risk: fake certainty. If someone tells you, "This will definitely happen next Tuesday," that's usually marketing, not analysis. Real markets don't sign contracts with your calendar. So what do? We do what adults do. We verify the pieces we can, we assume some claims are wrong, and we anchor on what is hard to fake. Physical premiums, delivery delays, official policy shifts, and the behavior of large buyers. Now pivot with me to the bigger framework, trust. Credit is trust with a price tag. If trust breaks, credit stops. If credit stops, trade slows. If trade slows, everything you take for granted, inventory, shipping, financing, gets choked. This is why metals matter. Not because we want drama, because collateral matters when trust wobbles. And we're walking into a world where more governments want programmable money, where your access can be switched off, where saying the wrong thing can become a financial penalty. We've already watched previews of that mindset: deplatforming, payment blocks, account freezes, and compliance as a lifestyle. So when people say, "That could never happen here," our response should be, "It already happens in pieces. The only question is scale." Now, bring it back to the market. Why are we seeing such violent swings in silver and gold at the same time? Because two forces are colliding. Force 1, the financial system is loaded with leverage and dependent on cheap funding. Force 2, the physical metal markets are not built for a stampede. When those meet, you get snap moves, gaps, overnight spikes, smashes that look irrational. But irrational to whom? To the person watching the chart in isolation. To the person who thinks spot equals in stock. To the person who thinks paper and physical are the same product. They're not. Paper is the claim. Physical is the escape hatch. Now I'm going to say something that sounds harsh, but we need to hear it. In a true system break, you are either positioned ahead of time or you are not positioned at all. If you're not positioned, your problem won't be price. Your problem will be permission. And permission is the one thing you don't want to beg for when everyone else is begging too. So what's the play? Not hype, not panic, a plan. Here's the mistake most people make again. They wait for a perfect moment. They want the exact bottom, the exact top, the exact ratio, the exact headline. That desire is normal. It's also how people get frozen. The better strategy is tranches, steps, pre-decided triggers. Because we can't be perfectly right, but we can avoid being catastrophically wrong. If you're thinking about switching between silver and gold, don't turn it into a single dramatic bet. Build a ladder. Pick the ratio ranges that matter to you, then divide your action into pieces. When the ratio hits your first trigger, you execute a slice. Not the whole thing, a slice. Then you wait for the next trigger and execute the next slice. That reduces stress, it reduces regret, it stops you from getting whipsawed by one wild day, and it keeps you from making the worst decision at the worst time, deciding under duress. Because the worst time to decide is when the market is screaming and your phone is lighting up and your emotions are doing parkour. So we decide while calm. Then we follow the plan while chaos is loud. Now, let's clean up one more dangerous confusion. When you hear sell silver, a lot of the time the message is really sell paper silver. Paper contracts can fail. They can settle in cash. They can get rules changed. They can get margin hiked until you're forced out. Physical metal doesn't do that. It sits. It waits. It doesn't default. So we should be precise with language because language controls behavior. Paper is a position. Physical is a possession. That difference is everything. Now, I want to pull you into a scenario that people underestimate. Imagine the big momentum trades, tech, crypto, the stuff everyone loves, start to wobble because funding tightens. The late crowd always does the same thing. They say, okay, now we want safety. But they all say it at the same time. And when they arrive, the safe harbor isn't an empty beach waiting for them. It's a small dock with limited space. So let me ask you a question that should make you uncomfortable in a productive way. If millions decide they want physical protection in the same month, who gets it? The first movers, the organized, the institutions with relationships, not the person who waits for the confirmation candle. That's why premium behavior matters more than spot behavior. Premiums are the physical market speaking. Spot is the paper market shouting. And yes, premiums can be annoying, but they're also a signal. When premiums rise while spot whips, it means physical demand isn't blinking. That's not a guarantee of profit. It's a clue about stress. Now we have to talk about attention, because attention is money now. Your feed will try to hijack you with extreme claims, deepfakes, fake breaking news, numbers stated with absolute certainty. We need to resist that addiction. The best edge we have isn't being the most emotional, it's being the most disciplined. So here's our protocol. If a clip gives a specific date for a system failure, we treat it as entertainment until proven otherwise. If a clip uses real quotes but twists the math, we treat it as a warning sign, not a guide. If a clip makes you feel like you must act in the next 30 minutes, that's manipulation. Real wealth building doesn't require a panic attack. Now, does that mean we do nothing? No. It means we act with structure. We buy, swap, hedge, or hold according to a plan that was built in calm, not in fear. Now I'm going to give you the two questions that matter most in the next phase. If we're wrong, where will it show first? And what's the market paying for? Growth or safety? Because if the answer shifts towards safety, metals don't need a story. They become the story. And if the answer shifts toward a credit event, metals become the measuring stick. We're not here to predict with arrogance. We're here to measure with humility. So where does that leave us today? It leaves us watching three pressure gauges at once. Japan's yield stress and what it does to global funding. Physical availability and premiums in real time. Sovereign behavior, repatriation, critical material lists, and policy moves that signal distrust. That's the triangle. And inside that triangle, silver becomes more than a trade. It becomes a stress test. Now, quick community moment. If you've been noticing premiums rise, delivery times stretch, or certain products vanish faster than others, drop a comment and tell us what you are seeing where you live. Are shelves normal, or are they thinning? Second question. If silver spikes again overnight and then slams back, do you think that's real selling or leverage getting squeezed? I want your take in the comments. And if you want more of these high-speed breakdowns, no fluff, no time wasting, hit subscribe. One click, that's it. Stay with us, because the next phase won't be calm. It will be fast. And when it moves, it won't ask permission. It will just move. And it ends with a question that should keep you alert. When the paper market finally loses control, do you think it happens on a slow Tuesday or in one violent weekend when everyone reaches for the same chair? Keep your eyes open. The quiet parts are where the trap gets set.